Hello everyone. This is going to be the first educational trading video for the Method Model Discord server. This is for complete beginners. So I'm pretty much going to do this all one take for each clip. So my apologies if I mess up my wording. I will try my best to make everything as straightforward, simple as possible and get this done in one take. That is the goal. Like I said, this is for complete beginners. So in this video today, I'm going to be covering what futures trading is, how the futures markets work, what you need to start, basic chart reading concepts, and what I would learn in order if I was starting over today. The goal here is to give someone with zero experience a roadmap for getting started. So if you're watching this video and already have any type of experience or knowledge about futures, smart money concepts, anything of the sort, you'd be better off to skip this video, as it's going to be lots of information you already know, very basic stuff. Overall, not much that could benefit you if you already have experience. To start this video off, before I go into any more detail about anything at all, I'm going to very much preface that trading is a skill. Don't expect to watch 1, 2, 3, 4, 5, 10 videos and immediately make money or understand what's going on. Your first goal should be learning, well, I should have wrote here, the first goal should be learning the basic concepts individually, then learning how to execute a repeatable setup with said confluences correctly and not making income. The goal is consistency. So starting off with what futures trading is. In short, futures trading, you are trading contracts. So these contracts, it's an agreement of price which tracks an underlying market. These are some very popular main futures contracts that I put up here: S&P 500, NASDAQ, oil, gold, Bitcoin. All of these markets can be traded through futures. There are two types of futures contracts: minis and micros. Full-size regular futures contracts are minis. Micros are 1/10 of the size of a mini, meaning one mini contract is 10 micro contracts. Now the CME is actually rolling out nano contracts pretty soon, which is going to be the 10th of a mini, but since it's not officially released yet, I won't bother explaining that at the moment. Just focusing on these two, minis and micros, that's all you'll really need anyway. These are the ticker symbols for these main marketplaces. So the S&P 500, the mini contract for the S&P is ES. The micro contract is MES, which is the micro S&P 500. For NASDAQ, it is NQ, with the micro variant being MNQ. Gold is JC, MJC for the micro. Oil is CL, MCL for the micro. Bitcoin is BTC and MBT for the micro contract. Not much else to say about this. So I'll get on into how the futures markets work. So in futures, there's two types of positions that you could be in at any given time, either a long or a short. This is one of the advantages of futures over many other styles of trading. You can make money on each side of the market. If price is going down or up, you can make money either way. These are the two positions that you could be in. A long is just your typical, you buy, price goes up, you sell for profit. Price goes down, you sell for a loss. Now a sell position is called a short, and entering a short position means that you are selling before you buy. So you're opening your position with a sell. If price goes down, you're buying for profit, and if price goes up, you're buying for a loss. So just to mark this out as an example here, I have the position tool here, two simple trades. Your entry is at the middle right here where the red and the green collide. For a long position, you enter here. If price goes down below the bottom of the red box, that would be your stop loss for this example. That means you lose. Simple. Price goes up, hits the top of the green box. Again, for this example, that means you're taking profit at this point. You make money. Pretty simple. Vice versa for shorts. You're entering here. If you enter a short position, that means you're entering a sell. You are anticipating lower prices. If you enter a sell, price comes up, reaches your stop loss, the top of the red box. That means you lose. Comparatively, if you enter a sell position, price goes down, hits your take profit at the bottom of the green, that means you win. You're making money. Moving on to contract value. Futures contracts move in two values, either points or ticks. One tick is the smallest price increment that the contract can move. A point is a larger unit of price made up of multiple ticks. So using NQ as the example, I'll say now as a side note, in pretty much all educational content that I will be releasing, and that will be most likely posted in this server, NQ will be the main market which is used for all these educational videos, as that is what I trade, that is what Top Tick trades, and many others as well. So with NQ as an example here, now this is the regular NQ contract, the mini contract, not micro. For the mini NQ contract, the regular contract, this is the one that I'm on right now. One tick is 0.25 points or 25 cents. So you see this is the price of the contract right here. At the moment, NQ is at 29,650 whatever. A 25 cent move in this number right here is one tick. A $1 move in this price right here is 1 point. 4 ticks is 1 point, meaning 1 point is $1. In terms of the mini futures contract, each point is $20. On the micro NQ contract, MNQ, each point is worth $2, which is 1/10 of the regular mini contract. So as an example here, one contract for each of these examples. A 10-point move with one NQ contract is $200, $20 per point. A 10-point move on micro NQ, MNQ, is $20, which is $2 per point. This is how risk is calculated in futures. If you are curious about or wondering how to calculate risk for futures contracts, how much risk you want to put on each individual trade, this is the simple formula for all that. If you're using a mini NQ contract, regular NQ, and you have a 20-point stop loss, that means you're risking $400 on that one given trade. If your stop is 50 points, you're risking 1,000. If your stop is 10 points, you're risking 200. That is how profit and loss is calculated with futures. Let's see. Now moving on, I'll go over what is needed to start trading. One of the main reoccurring questions that most people have who want to get into trading or start, typically it's something along the lines of, how much money do I need to start trading? Do I need money saved? How much do I need to invest? What do I need to do? How do I set it up? What platform do I use? All those questions I've heard many times. Truthfully, when you're first starting to learn how to trade, your expenses and money invested should be near $0. There's one real expense only, and I'm talking about this to complete beginners. Once you get to the point of having a strategy that you have back tested, forward tested, live traded on demo, gathered a lot of data on, once you've reached that point and you are ready to put actual risk on the table, then that's when you start trading prop firm accounts. You're paying for evaluations, you're paying these different fees, whatever it may be related to prop firms. I'm not going to mention any of that right now. Assuming anybody watching this is a complete beginner. When I say complete beginner, realistically, I mean your first 6 months of trading. If you're within your first 6 months of trading, you're in the extreme beginner stage. You are learning, obtaining knowledge, and learning how to apply that by yourself on the charts. You should not be focused, like I mentioned at the start of this video, you should not be focused on making money. You should be focused on building your skill of trading. In the long run, that skill set is going to be with you forever, and that is what's going to make you exponential amounts of money. So, for your charting platform, what are you going to use to view the chart and to overall watch the market? You're going to use TradingView. This is TradingView I'm on right now. Most people use this. This is the charting site that I use. The good thing about TradingView, first of all, you could get started for free, and it also has a built-in demo trading account for free. So when you sign up, you make an account, you load up the chart. You could go here to trade, paper trading. This is your demo account. Could connect to that, and then boom, you now have a demo account which you could trade, practice on, and learn to apply the concepts that you're learning, all for free. The only expense is going to be real-time market data. And this is for TradingView. This is because when you create a TradingView account, you're going to have delayed data. So the markets are going to be delayed by 10 minutes compared to real time, what's actually happening. and that applies to pretty much all contracts. So to get access to real-time market data, you will need to purchase this subscription for TradingView. All you need to do, if you search up TradingView real-time market data, you'll find the site which you could purchase this at. And this is the exact bundle that you need to buy. The CME group, which is E-mini included. And this is $9.80 per month, Canadian dollars. That's what it comes out to. It's very cheap. Realistically, if you can't afford this, you should not be trading. You should get a job. But this is the only expense as a beginner that you will have for trading. Aside from this, you're not risking any real money. You're not buying any accounts. You're not doing any of these things. You are purely demo trading, back testing, and forward testing. That is it. All right, moving on now to basic chart reading concepts. So in terms of order types, there's 3 main order types, and then these two are related. First is a market order. Market order refers to an immediate entry. When you buy or sell at market, that means you are entering at the nearest available price, which you could get filled at. A limit order is a specific price or level that you want to enter at. You're not entering immediately. You're setting the limit order at a specific price, and if or when price reaches your limit order, you will get filled into your position at that precise area. A stop order triggers once a certain price is reached, pretty similar to a limit order. However, a stop order is typically used once you're already in a position as a stop loss. That is what I have here in brackets. So your stop loss is technically a stop order, and that exits the trade when you are wrong. A take profit, typically in the form of a limit order, will exit the trade at your target. So just as an example here, I could just show an example, completely random, but I'll use the 4-hour chart here for this. Let's do market order to start. Let's just say, geez, I don't even know. Okay, it's completely random. No actual strategy or thought process behind this, just for the sake of an example. Let's say you want to buy market here. Off the closure of this candle, you want to enter a long position. If price works down to this swing low here, you want to mitigate your risk and exit the position to prevent further loss. And more importantly, because for this example, I could assume that if price works down below this swing low, my trade idea and what I wanted to see play out is incorrect. It will not play out in my favor. This is my stop loss. Let's just say my target for this example is these highs right here, just for the sake of it, because it already got taken. So if I enter this at a market order, that means I'm immediately entering here at this point when I click the button. I will then have my stop loss, which is a stop order. That will be right down here at this swing low. If price comes down and hits my stop loss, my position will be automatically closed for this specific amount of loss. My take profit in this case would be in the form of a limit order, meaning my take profit / limit order would be set up here. price comes up, reaches my limit order here, and as soon as price hits right here, the limit order, my position is automatically closed at this point, and I'm completely out. Now this is a 4-hour chart, so this is kind of a huge position. I wanted to make an example of the points. What I could do is go down to like the 1 minute. Find something not from this morning though, because it was absolutely horrendous price action, but you know what, whatever. Let's say that I want to enter this IFVG right here. I'll be making a video on that concept in particular one of these days, but that's not important for the point of this example. Let's just say, boom, want to take this entry here. I'm taking profit at the AM highs. So again, this is a market order example because I want to enter as soon as this candle closes. As soon as this candle closes here, I enter market order. Stop loss, stop order is down here, take profit, my limit order is at the high right here. If price comes down to this point, I will be stopped out for a loss. If price comes up to this point, which it does, I will have taken a win. These numbers here on the left side represent the amount of points that price has moved from the entry to the target or to the stop loss. So in this case, my stop loss is 42.5 points or 170 ticks. My take profit is 100 and a quarter points or 401 ticks. What this means is my risk to reward for this trade is 2.36. 2.36 risk to reward means that if this trade plays out in my favor, the reward is 2.36 times what I would have lost if price stops me out. If I entered this position with 1 mini, my stop loss is 42.5 points or 170 ticks. What would that come out to? Off the top of my head, I'm not going to do that math. Instead, what I will do for simplicity purposes is set this at 50 points. So if my stop here was 50 points, this is a 50-point stop, and my target is still the same. Let's just say 100 points. Make it simple. This is a 2 risk to reward, a 1 to 2 risk to reward. That means that I'm making 2 times the amount that I'm losing if this trade plays out in my favor. 50-point stop with 1 mini contract means that if price comes down to this point and stops me out, I will lose $1,000. If price plays out in my favor, that would be a 2 risk to reward. What does that mean? I am making $2,000. I'm risking $1,000 to make $2,000. Pretty simple, straightforward. I'll do an example here for a limit order as well. So let's just say something like this. Price is coming up higher here at this time, and this is going into around 10:28 a.m., 10:27. Let's say at this point, again, this is just an example, but let's just say I have confidence based off of my model that if price comes back down and taps into true day open, which is this blue line here, I have confidence that if this level here gets tapped, price is going to flip and continue back higher. This means I could set a limit order right at this level here when price is up here. So here's what I'll do. Let's just say, let's do something like this. Something like this. So price is up here. Price is up here at this point. Let's just wait for it to load in. And again, this is just an example, completely hypothetical. In this example, my model says that if price comes down to this level right here, I have confidence that we will react off of this level and continue higher. So at this point, what I could do is I'll set my limit order right here at this level. If this specific price being 29,538, if this level gets hit, I will now be entered into a buy position. My stop loss will be enabled, meaning that if I get filled here for my limit order and price comes down to my stop loss, I will lose. This stop loss here is 20 points. Using the example of 1 mini, that means that I will lose $400 on this trade if it works down to this point. The risk to reward is 4.28, and I'm targeting 85.5 points for the high here. So quick maths off the top of my head. Let's see, 400 times 4.28. That's 1,712. So approximately $1,700 of profit will be what I make if I get filled here and price works to my take profit. So I set my limit order here right now. I actually can do it in replay mode. Pretty cool. Let's go here, buy limit, and I could drag here my stop loss and take profit. So boom, I'll put my stop loss right here. I'll put my take profit right here. So again, this is exactly what I went over. I buy right here. I now have a buy limit. If I get filled here and price works to here, I get stopped out. If it rejects and trades to the high, I make that much. So let's see what happens. I get filled right there. You could see just barely, but price does by the tick work to that limit order. Price begins to trade higher. And then bang, I hit TP right there, and this trade plays out. Just made $1,700 on that. I think that is enough examples of that. Not much else to say there. Moving on, the next thing I'm going to briefly cover is candlesticks and time frames. Then I will move on into the last area of this. This has actually been a pretty lengthy video to record, I cannot lie. Anyway, important information. So, candlesticks. Each one of these bars here are a candlestick. That is what they're called. These are called candlesticks. If you are not aware of how they work, there's two types of candlesticks. There is green and red candlesticks. For my chart, they're not green and red because I changed the color. The quote-unquote green candlesticks are white for me, and the red candlesticks are gray. So, sorry if it's a bit confusing, but overall, the idea of it is pretty simple. I could draw it out here, maybe that'll be easier. So let's just say here, let's do this. Let's just do this. This is very whack, but doesn't have to be perfect here. Just needs to do the job. So this is an example of a green and red candlestick. Again, the green one here refers to the white candlesticks on my chart. The red is the gray. What a candlestick is it is the contents of price data for a particular period of time. For this example, we're going to assume, and this ties into time frames as well, so we're going to assume for this example 1 minute. Each of these candlesticks represent 1 minute of price. For the green candlestick here, what this represents is this. Price opened right here at the low of the candle body. The high of the candle body is where price closed. These on the tops and bottoms are called wicks. Almost every single candle will always have wicks. The wick is the highest and lowest point that price moved in this period of time. So pretty simple here. Price opens at the low of the body candle. This is the lowest price that is put in. This is the highest price that is put in. And the 1 minute candle closes right here. And this leaves this signature candlestick. If I was to draw it out in the span of 1 minute, mind you, this is in the span of 1 minute, this is pretty much what price did based off of this example right here. Price opens, let's say it does this, works lower, up higher, like that. Maybe it comes back down a bit, and then boom. Assume this is a 1 minute period of time. Price opens here at the body. The lowest low that is put in is the low of this wick. Price trades up higher. The highest point in this 1 minute piece of price action is the top of this wick. Price comes back down within the range and closes here at this point at the end of the 60 seconds. And this is the closure of the candle. So this is an example of what price action could look like, and this is the candle that would be printed based off of this price. For the bearish candle, for the red candle, it's very similar, just opposite. So the difference here, price is opening at the high of this candle body, and it's closing at the low of this candle body. The highest point in price being the top of this wick, and the lowest point being the bottom of this wick, that remains the same. The only difference is for a green candle, a bullish candle, price opens here, closes here. For a bearish candle, price opens here, closes here. And a candlestick could represent any amount of time. This could be a 1 minute piece of price action. This could be 15 seconds. This could be 4 hours. It could be a week. It could be any of these things. And this leads also into time frames. So a time frame, all a time frame is, a time frame represents how much data each candlestick contains. Right now I am on the 4-hour time frame. These are all the time frames, so pretty much any time, any amount of time you could think of is possible to project. I'm on the 4-hour time frame right now. What does that mean? Each of these candlesticks on my screen represent 4 hours of time, each of them. If I go to the 15 minute, each of these candlesticks now represent 15 minutes of price action. If I go to the 1 minute, each of these candlesticks now represent 1 minute of price action. Pretty straightforward, pretty simple. I don't think I need to elaborate much more on that. Pretty simple. In terms of The use case for each time frame, it's dependent on the way most individuals trade, but the overall rule of thumb is that the higher time frames, and I'm saying this in the sense of day trading because I'm not talking about swing trading or long term because that's different. In terms of day trading, where you're trading intraday price action, the higher time frames, I want to write this out. Hold on, I'm just going to erase all this. The higher time frames being, I'd say, anything above the 15 minutes. So 15 minute or higher is for broad context and bias. The 5-minute and lower time frames, so I will say the 15-second to 5-minute. This provides you with low time frame bias and precise entries. This is just a rule of thumb, but this is not necessarily always the case. Everybody is different. Me personally, I don't enter on anything above the 1-minute time frame, so all of my entries are taken on the 1-minute time frame and below, not lower than the 15 seconds. So my time frames that I use for entry is the 15-second to 1 minute. Everything above the 1 minute I am using to dictate low time frame and high time frame bias alongside market narrative and overall just building context. This is different for everyone. For me, this is the case. So now moving on, that is all that I have to cover about the basic chart reading concepts. I'll now move on to the last point here. How long is this video? 37 minutes. Holy, I did not think it was going to be this long. If you're still watching this, good job. You're clearly dedicated to learn. This has been a long video, but this is a lot of value packed into a video right here. And if you could sit through this video, then you definitely have what it takes to stay consistent and disciplined with this skill set and become really good at it. So moving on now, the last section. If I could relearn from all the information I have today, how I would start, what order would I start to learn how to trade? So this is the 4-stage process that I have created here for beginners. The best, most efficient way to obtain the right information and to secure your fastest path to profitable, consistent, disciplined trading. So, first stage, futures fundamentals, we covered in this video. Contracts, points and ticks, long, short positions, order types, stop losses, position sizing, all these were covered in this video. So good job if you watched it all the way through. Moving on to stage 2, chart reading basics. Again, this was covered in today's video as well. Candlesticks and time frames mainly. I did not really touch on trends or market structure. However, I will explain where you could learn more about those. If I was to go over everything, this video would be like at least a couple hours long. So there's a lot of information to learn. If you are a complete beginner, do not let it overwhelm you. Just take it step by step. Process over profits any day of the week. That's all that matters. Focus on getting 1% better each day, and your progress will snowball over time. That is how trading works. Moving on to stage 3. After you have these basic fundamentals down and it's just all common sense to you. You want to learn smart money concepts. Some people call it smart money concepts, some call it ICT. ICT is the creator of smart money concepts, so that's why they're kind of intertwined. But in one way or another, you want to learn these. The simplest way to get a grasp of smart money concepts would be to watch the TJR bootcamp. I don't care what anybody says, or if you heard people say TJR is a scam or this or that, I don't care. This is the first thing I watched, which introduced me to futures, alongside many other people that I know, and it is extremely beneficial. The information is made in a very simple manner. The entire bootcamp is maybe like 55 videos, maybe a total of like 20 to 30 hours of content. That is just the bare minimum to be able to sit through, watch all those videos, genuinely comprehend everything that is being said in those videos, take notes, apply those concepts yourself on the charts, go back, watch the video a second or third time if necessary, and watch it from start to finish. That's all I have to say about that. After you finish the TJR bootcamp, next steps after that, really one of two things. You could either go down the path of learning straight from the source, which would be ICT. Reason why many people do not do this is because his mentorships are very lengthy. They're a lot more advanced as you dig deeper into them compared to the bootcamp that TJR created or anything that I've talked about today. So it's much more advanced, much more lengthy, and there's overall just a lot more, in terms of quantity, there's a lot more content and information to withhold and go through with ICT. So that's one path you could go down. The other path, I put the method model because really the goal of this server, this community, is to help take people who have a basic understanding of smart money concepts. Either they're not profitable yet, or maybe they're not consistent, or maybe they're complete beginners, whatever it is. But with the information provided from TJR's bootcamp, which is the complete basics, to be able to take all those confluences, those concepts, and combine them to create a strategy, to create a system which is both consistent and profitable, proven by data. So I put this server as the last option there, as this server is a great place to learn how to take all these concepts and create a model out of them. The method model refers to a combination of pretty much two models that both me and the other owner of this server trade. So we each have our own separate models, but we call it combined the method model because that's just what we called it. Our goal of this server is to teach this model to others, help you apply this system to your trading, and these are proven winning systems, by the way. And through the application of these systems, the goal is to make you gain consistency and overall profitability trading this model. Of course, there's many other trading influencers or just traders online, and as long as they're credible, you could learn pretty much any of their models. Almost every model is a good model. Many people who are beginners, they may be wondering, what's the best strategy I could trade? What's the most profitable strategy? What's the easiest strategy to learn? What's the best strategy for beginners? None of those questions really make sense once you understand how strategies truly work. Of course, there's some strategies which just flat out don't work, but assuming that the strategy actually has been tested and has a proven edge in the market, any strategy is a good strategy. It all comes down to personal preference, It comes down to personal preference and how each individual views the market. Everybody perceives the market differently because we're all humans and we are all different. We process the information that's in front of us differently. For that reason, there's many different people who are profitable trading many different strategies. Some people trade supply and demand. Some people trade support and resistance. Some people trade trend lines. Some people trade smart money concepts like me and many others in this server. Some people trade order flow and book map and heat map and all these other things. So there's many different people that trade different things. You should not listen to anybody who says that one methodology of trading is superior to the others, because it is completely down to personal preference and understanding. Enough said there. Last thing, stage 4 is application. You have to apply all these concepts and all this education that you have now consumed. Stage 4 really should be done throughout this entire process, so you should not wait until the end to start doing this. Instead, you should be doing stage 4 throughout the entire time you're learning the first three stages. And that is backtesting, forward testing, demo trading. Backtesting refers to going back into old price data and testing whatever it may be that you're learning, whether it's a specific confluence, whether it's a strategy, whatever it is. If I go back in my chart right now and I do this, and I go to this random part in price here, this is November 2025, and I start to mark out everything that I see here, and I have a strategy that I'm trying to test, and I see how this strategy that I'm testing could align with this specific area in price, this is backtesting. Forward testing refers to live trading in the market and not executing any positions, but seeing how price plays out in real time as per your system or confluence, whatever it may be that you're trying to test and gather data on or just gather experience on. It is recognizing it and taking note of it in real time without any execution. Demo trading, paper trading, same thing. That just applies to trading with fake money. Paper trading right here, this is demo. That's what I refer to as demo. That just means you have a prop account, a demo account with however much money in it, and you could use that demo money to experiment, to gather data, to test out, to build consistency, all these different things. That should all be done via demo trading. This video is now at almost 50 minutes in length. So for anybody who has stuck through to the end here, clearly you're serious about learning this, and here is some little sauce that will, if you keep these in mind throughout your entire journey, it'll make your life so much easier. You'll make so many less mistakes. I spent many months at times caught up in certain issues within this. So being able to prevent these things, it will help a lot, and it'll overall just make your whole journey and process way easier than what it would be if you're making these mistakes. First of all, protect your capital. Surviving long enough to learn matters more than making money quickly. This ties into what I said at the start of this video. Your goal should not be to make money, it should be to learn and to improve your skill of trading. Don't strategy hop. That's another thing. I've struggled with this in the past, and I'll be honest, I even struggle with the thought of this up until this day. The difference is I don't let the thoughts get to my mind. I just ignore them. In the past, I would not be able to ignore them, and I would struggle with this. If you're constantly switching models or strategies, this is preventing you from collecting a large quantity of data. Data collection is by far one of the most important things as a trader. That is what proves to you that you have a winning system and an edge in the market, and it's one of the most important things. If you're constantly switching your model, you're not going to be able to collect a significant amount of data, and what that's going to lead to is a lack of confidence. It's going to lead to fear each time you enter a trade. It's going to lead to a whole bunch of different psychological issues every time you take a loss and you begin doubting yourself, you begin doubting your system, or if anything even works for real. Overall, it just causes a lot of issues. Don't do it. Learn one strategy that clicks with you, stick with it, and just go at it. Continue to gather data, backtest it, forward test it, live trade it, and you will get better. Now, don't overload your chart either. Again, this is another thing I used to do in the past a lot when I was maybe in my first year or so of trading. Just because you're learning all these new concepts, you do not have to use all of them at the same time. It is actually going to affect you negatively more than it will positively. So you should not be overloading your chart with a million different things. As a beginner especially, you're going to get overwhelmed and you're going to get so-called analysis paralysis, and you're just going to be lost. So don't do that. Context comes before entry. This is something which you will learn more if you're a complete beginner, not from this video necessarily, but as you pursue your journey. A simple concept of any sort or a couple of concepts is not enough to take a trade. Context surrounding the entry matters 100 times more than the entry itself. Know where price may be going before worrying about where to enter. This just comes down to having a directional bias in the market. Again, that's something you will learn more of over time as you continue to gather knowledge on trading. Trade one repeatable model. Ties into the no strategy hopping. Just stick to one model that's able to repeat on a consistent basis. Gather data, backtest, forward test. It'll make your life a whole lot easier. You'll gain consistency a lot faster. Journal everything. From the first video, from this video, honestly, you should already be taking notes. Maybe you already know the stuff I'm talking about in this video. Okay, you really should be taking notes still. If not from this video, then I'm telling you right now, this is one of the criteria moving forward. Whatever video you're watching after this one, trading related, take notes of everything. Journal everything. And then when it comes to your actual trading itself, when you are paper trading, when you're demo trading, you should still be journaling. You should be journaling each entry that you take, why you took it, how you felt as you took it, what you did good, what you could have done better, the lessons that were learned from that trade that you took, how you could have improved. All these things should be journaled every single day. No exceptions. I've been journaling every day for the past over 2 years. So you should too. Think in probabilities. No trade has a 100% success rate. No strategy has a 100% win rate. It's not possible. If you had a strategy with a 100% win rate, hedge funds would be hunting you down, kidnapping you, and you would never see the light of day again. So there's no strategy out there, I could promise you, that has a 100% win rate. You have to think in probabilities. Even if it is a perfect setup and it fully follows your strategy, you will have losses. No matter what. Everyone has losses. Backtesting gives you confidence in data, not certainty about the next trade. Again, ties into the probabilities. Just because you have a proven winning system that does not mean that your next trade is going to certainly play out in your favor. And that is why risk management is always very important. And this ties into the last point of master execution before increasing risk. Oftentimes, risk management could be the dictating factor between a profitable or unprofitable trader. If you're risking inconsistent from each trade, this ties into the non-certainty. You don't have certainty that your next trade will win. What if your next trade's going to lose? What if your next trade's going to lose, you don't know it yet, and then you're doubling your risk going into that trade? That should not be the case. You should be risking consistently the exact same every single trade. Even if you're on demo, doesn't matter. You should be risking the exact same every single trade. So that way, if you have a true edge in the market, the edge will become visible, presented through your P&L as you continue to trade consistently because of your risk management. This video is now almost an hour long. This is crazy. I honestly intended this to be a 20-minute video, but this is how long it ended up being. I hope that if you watch this, you could have gotten some education and knowledge out of this video. And if you made it all the way through, then respect, because you have what it takes in terms of I don't even know what I'm saying at this point. This video is too long. Anyway, I'm just going to wrap it up here. This is it. I'll be posting more educational content over time. It just takes a long time to make. This is for complete beginners. My next video, most likely I'll be covering fair value gaps and inverse fair value gaps, as that is pretty much one of my main things that I trade. So that will be what I cover in the next video, a bit more advanced, but assuming that you watched through everything today, now you're going to go watch TJR's bootcamp. You're going to gather a lot more knowledge about the stuff he talks about in there, and you'll be ready for when the next video is released to learn some more. So hope you enjoyed. Let's crush it, and I'll see you in the next one. God bless.